Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today, we're looking at NOVONIX.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis.
Uh-huh.
We're looking at a company that's trying to do something really difficult. They're focused on producing synthetic graphite anode material.
For EV batteries.
Exactly. And they're positioning themselves to be a core North American supplier, which is, a huge deal right now.
Okay, let's unpack this, because looking at the recent figures, the top line is pretty small and a little bumpy. Revenue for 2024 was what, about $5.85 million?
Okay.
And that was actually down about 27% from the year before. So why should anyone even look past a trend like that?
That really raises the most important question, doesn't it? The current revenue is, you could call it subscale. That's capacity constrained, and that's by design.
By design.
Yes. What's fascinating here is the model that analysts are underwriting. They're projecting just massive growth. We're talking over 165% in 2025, and then a really steep ramp of over, 1,344% in 2026.
Whoa.
So this isn't the story about today's sales. It's more like a call option on their manufacturing scale-up in Chattanooga.
Okay, a call option. But what about profitability? $74 million loss on less than $6 million in revenue? That sounds alarming.
It does, and that combination is, it's very characteristic of a high-growth specialty materials platform that's deep in its investment phase. While the net margin is deeply negative, and that's driven by heavy R&D and all the fixed costs.
Following out the plant.
Exactly, the plant build-out. But the reported gross margin is extremely high, around 76.25%.
76%.
That's right. And that reflects the high value of their engineered materials and, their testing services. Once they can get those Chattanooga lines running with multi-shift utilization, that fixed cost absorption should drive some powerful operating leverage.
So the whole financial setup is basically a bet on future capacity soaking up all those fixed costs. What about their health today, though? Are they highly levered?
Not highly, no. They have total assets around $226 million versus liabilities of about $88.5 million. Long-term debt is pretty modest at around $32.8 million, and they have positive working capital. It's a manageable balance sheet for this kind of capital-intensive scale-up.
Okay, that makes sense.
And if we connect this to the bigger picture, the core investment thesis is really about their competitive moat. It relies on two things: their technology and the strategic localization.
So what are the core elements of that moat? How do they protect themselves?
First, the technology. They have a history in advanced battery testing, which gives them this deep cell-level performance data. It's like a kind of R&D and qualification moat.
Right, so they know what works.
They know exactly what works. And more recently, they delivered their first industrial-grade synthetic graphite sample to a North American carbon processor. That's a crucial proof point that they're moving past the lab-scale stuff toward true production. And that creates technical switching costs for the car manufacturers, the OEMs.
Okay, and this is where it gets really interesting for me. Their location in North America seems absolutely key.
Exactly. Their strategy aligns directly with U.S. and Canadian policy incentives.
The ones designed to localize the EV supply chain.
Precisely. This is a huge structural tailwind.
Right.
You have geopolitical constraints, potential tariffs, and the IRA legislation. All of this severely disadvantages the big Chinese suppliers when they're trying to serve U.S. or European OEMs.
So NOVONIX is positioned as, what, a first-wave Western anode player?
That's a perfect way to put it.
But we have to talk about the Stellantis termination. That was a huge piece of news.
A very big deal.
A major offtake agreement, 86,250 tons just canceled. That tanked the stock, and it raised some very real questions about their ability to execute. What does this mean for that execution risk?
Well, the market view is, I'd say, modestly bearish to neutral right now, and it's largely because of that execution risk. The termination notice cited an inability to agree on product specifications and production milestones.
Which basically validates the concern, right? That the technical specs and ramp timing are super challenging in the EV supply chain.
It absolutely validates it.
It sounds like a pretty significant hit to sentiment.
It is, but I think the market has largely priced in that skepticism by now. The stock is trading near that $1 level, which has become a key psychological support zone.
So any upside to that disaster?
The upside maybe is that this setback might refocus management on fewer, higher probability programs. And crucially, they still maintain these entrenched relationships with Tier 1 counterparties, people like Panasonic Energy and Volkswagen's PowerCo.
Right, the really big fish.
The biggest. And despite the setback, we've actually seen some powerful counter-catalysts. Just recently, the company delivered that industrial-grade sample we talked about.
And the stock spiked double digits on that news. I think it was over 16% intraday.
It was. And that shows the market recognizes the significance of any execution win, no matter how small it seems.
That high beta reaction is exactly what we look for when stocks are compressed down near their lows, isn't it?
It is. It signals that expectations are low, so any good news has an outsized impact.
And what about institutional interest during all this uncertainty? Has the smart money been moving in?
This is a critical signal. A firm called YA Thai PN became a substantial holder back in October, acquiring an 11.03% stake.
11%. That's not a small position.
Not at all. It signals that significant institutional risk capital is stepping in at these depressed levels.
Yeah.
It effectively validates the equity story, and it strengthens the capital structure, especially after that debenture conversion and share issuance.
So looking ahead, what are the key near-term milestones we should be watching for over the next few months?
The immediate focus has to be on sequential revenue acceleration. We need to see it in their next quarterly reports. And we need commentary around volume shipments, not just samples.
And on the more speculative side?
We should look for potential expanded contracts with Panasonic or PowerCo. And importantly, any news about government funding.
Loans or grants tied to those critical minerals incentives in the U.S. or Canada.
You got it. That kind of policy support would de-risk the Chattanooga build-out substantially.
So pulling this all together, what does it all mean? The technicals sound like the stock is just washed out and waiting.
They really are. Momentum indicators show no strong current trend, which means the stock is in a range-bound sort of basing phase.
Consolidating?
Right. And for a high beta stock like this, that means positioning is light. The stock is coiled at these depressed levels.
Coiled and ready for a big move if the news is right.
Precisely. Any positive fundamental news like a new high-quality offtake or a major REMP milestone, it has the potential to drive some really outsized upside.
So it sounds like a high optionality play. The valuation is heavily discounting the execution risk, but consensus is still banking on explosive revenue growth in the medium term.
That's the perfect summary. It's a binary bet on whether they can transition from being a technology company to a true industrial powerhouse.
That wraps up our analysis on NOVONIX today. This is a story defined by a multi-year effort to localize the EV supply chain. While the risks are clear, specifically that execution risk, the structural tailwinds and institutional support present a really compelling setup for anyone with a long-term view.
Indeed. The question for you is whether this high beta, high optionality stock can bridge that gap from the pilot phase to industrial scale with its remaining Tier 1 partners. Make sure you hit subscribe to Smart Wealth with Joshua for our next daily stock analysis.